Our project is on McDonald's and Wendy's. So McDonald's is our base company, and then Wendy's is the comparison company. So let's go over the content overview. We're first going to do an introduction and company background, fundamental company analysis, competition, discuss competition and market position, valuation and analyst perspectives, risk assessment, strategic outlook, and finally, an evaluation and recommendation. So first, let's go over a company overview. The legal name is McDonald's Corporation. The ticker symbol is MCD. It's traded on the New York Stock Exchange. The headquarters is in Chicago, and the industry is restaurants, obviously. And then a little description is that McDonald's operates and franchises a global system of restaurants in more than 100 countries, which will become important later. And the firm earns a significant portion of its revenue from franchise royalties and lease income, in addition to company operated restaurants, which I did not know, and I thought that was interesting about making the franchise so profitable. And then some key statistics are the normalized PE is 25.15 times, and then the ROA is 14.77 TTM, and TTM is trailing 12 months or the last 12 months, so it doesn't have to follow a calendar year, and this metric provides more up-to-date data. And the normalized PE is adjusted for unusual events like the pandemic, and it provides a better gauge of real valuation. And then compared to Wendy's, McDonald's is outperforming them in both the normalized PE and ROA ratios. So McDonald's uses a franchise-heavy business model which provides strong profit margins and recurring revenue streams. Given its worldwide presence and brand recognition, it's considered a globally diversified leader in quick service restaurants. And then for comparison later, we'll look at how a company like the Wendy's company stacks up in scale, margins, and growth. So next, let's talk about McDonald's stock price and the trend over 5 years. So there's a chart here. Blue is McDonald's and red is Wendy's, and the comparison is pretty drastic. So price trend shows resilience and recovery after some post-pandemic lows for McDonald's, but the opposite kind of happens for Wendy's. As you can see, McDonald's kind of goes up slowly, and then Wendy's kind of drastically goes down. So McDonald's shows a smoother trend due to larger scale and global diversification. Wendy's lacks this and is dependent on the US, which could be why it's so downturned. So when we examine the long-term chart, McDonald's shares have shown a steady upward trajectory with less volatility than many smaller chains such as Wendy's. This reflects its scale, global footprint, and stable cash flows. Like the thing about the franchise, Wendy's, I guess, might not have that same income. So Wendy's exhibits greater swings and maybe higher possible potential, but also higher risk. Like Wendy's might decide to shoot up, but we don't know yet, and it looks to be going down. So the steadiness of McDonald's is one of the key investor attractions. So next, let's talk about some recent developments and the macro context. So within the restaurant industry, there's been a lot of expansion of digital ordering, which I know from first seeing that firsthand, remodeling of restaurants, and global drive-through enhancements, like maybe the AI talking to you instead of an actual employee. So some macro factors are consumer discretionary spending, wage inflation, commodity cost pressures, and global supply chain constraints like tariffs. Competitor context, Wendy's is more US centric and thus more exposed to single market risk, as we talked about, but McDonald's has global diversification. As we said, they're in 100 different countries, which is a lot different than Wendy's. I know that the McDonald's app is currently number 3 in the food and drink category on the App Store, and Wendy's is 23. So you can see maybe they're not keeping up with McDonald's in the same aspect of digital ordering, having their app, doing the point system. I know of more people who have and use the McDonald's app, including myself. I have the app and I've used it a couple times. So this shift to online ordering is something that all fast food restaurants will eventually have to have in order to be competitive. So recent initiatives by McDonald's include further investment in technology like mobile ordering and delivery, and rising franchise-led remodels, which support long-term competitiveness. At the same time, broader economic headwinds such as rising labor and food cost inputs, as well as inflation and interest rates, present challenges. Investors must consider how resilient McDonald's business model is under these conditions compared to smaller regional players like Wendy's. McDonald's global reach helps mitigate some domestic risks. So even if the US is not doing their best, obviously it'll take a hit on McDonald's, but for Wendy's, it's going to be a lot worse. So next, let's go over some key financial ratios. So these ratios show that McDonald's is highly profitable, efficiently managed, financially stable, and capable of sustaining steady growth. I'm sure you can read all those, and let's actually explain what they mean. So these ratios tell several important stories. The ROA of about 15% indicates McDonald's is earning a strong return relative to its asset base. The high operating margin reflects the efficiency and franchise model leverage. So, since they do rely a lot on lease income and the franchise itself, sales, hopefully, of the food take less of a hit on their operating margin. But however, growth is modest, 3 to 4% on the 3-year average, as you can see, which is typical for a mature global company, so nothing crazy. The liquidity ratios are modest, reflecting the company's working capital structure and long-term liabilities. So they do have a good amount of long-term liabilities. As an investor, one would value the high profitability and stability, but also recognize the trade-off of slower growth and higher valuation multiples. So when we compare these to Wendy's, we'll see McDonald's has a competitive advantage or vulnerability. Next, let's look at the profitability and efficiency metrics. I directly compared McDonald's and Wendy's, and just based off looking at both of them, they're pretty drastic numbers. Wendy's a lot lower than McDonald's. So McDonald's clear profitability and efficiency edge stems from its business model, heavy franchising, as I've mentioned, less capital tied up in company-operated stores and global reach, unlike Wendy's. So for Wendy's, which has fewer stores and more corporate ownership, the margin profile is weaker. From an investment perspective, McDonald's profitability gives it stronger margin of safety and greater ability to absorb cost pressures. The comparison reinforces why McDonald's is often seen as more of a defensive growth stock in the restaurant sector. I think these are pretty significant, and it also shows that if there's increases in cost, I think McDonald's would obviously be able to handle that a lot better than Wendy's, it seems. So next, let's go over some growth trends and financial health. So we have the 3-year revenue average and EPS growth amounts. They're pretty steady. We also have total debt, which is about 52% of total capital, and then liquidity, which are the current and quick ratios of 1.19 and 0.9. McDonald's growth profile is pretty moderate. I think it reflects its maturity. It's an older company. It's very well known in a lot of countries. I know you can travel and you can pretty much go to McDonald's anywhere. I think investors should adjust expectations accordingly. You're not going to have 20% of revenue growth in 1 year, or you don't think you will. While growth is not explosive, it is relatively stable and predictable, which is important, especially when you're buying stock for the long term. So the debt load is meaningful, but given its strong cash generation, the balance sheet is generally healthy, like nothing's really out of whack. Though any major disruption could challenge the leverage, so they do need to be bringing in money regularly. The financial health metrics show a stable but not overly conservative liquidity position. When we compare to Wendy's, we'll see whether a smaller company might offer higher growth but more risk. And I think that's seen in plenty of other companies and other industries, and whether McDonald's balance sheet gives it a relative advantage. We'll see about that. So an interpretation of this is that McDonald's shows mature growth, manageable debt, given strong cash flows. It has financial flexibility, but carries significant leverage that requires continued stable cash flows.
Hi, my name is Kiki Fotopoulos, and today we're going to go through slides 12 through 17, and I'm going to have my screen kind of split here to go through the side of Morningstar and then also the PowerPoint that I have that goes in hand with it. So first off, if we talk about the sustainability, environmental, and social governance risks, as you can see on the right-hand side, this is actually Wendy's, who we're going to be using as our competitor and McDonald's as the base. But I think it'll be good just to get a look at both. But we'll mainly be highlighting McDonald's in this case. So kind of looking at both screens, they both have a 3 out of 5 rating. And they actually both sit at a medium. So if we look more into detail about what some of these things mean, if we scroll down here, we can also see the equation for the Wendy's one, and then I have it broken down on the left-hand side for the McDonald's one. So with the manageable risks, that's the 40.7. This includes supply chain issues, food safety, and labor costs. And then with the unmanageable risks, so that's 2.9, which is a lower number, which is good. This is anything that arises from inflation or global events, just really out of hand. And then for the management gap, which is sitting at 62.4%, that leads areas like improvement for employee retention, strengthening cybersecurity, and adapting to customer preferences. Um, and all these things, they're not unmanageable, like again, the global events one. So these are things that you can, you know, as a brand, take a closer look at, more attention, move forward on. And then kind of an overall takeaway is McDonald's faces some exposure, but most risk can be reduced, like I said, with the management ones, like the gap, um, with better management skills, strategy, and communication. And again, this is Wendy's on the right. So if we move forward to the next slide here, we're gonna compare both of these. So I'm gonna have McDonald's on the left already kind of typed out, and then I'm gonna show you how to get to Wendy's on the right. So if we go over to analysis and then under comparables, you'll find Wendy's. And then it's kind of a little tight screen because I'm doing both. But if you scroll over, you'll see the competitors. So again, we have McDonald's, who we're going to look at on the slide. And then they have like Papa John's and Yum Brands. And Yum Brands was actually the second for McDonald's, which I found it interesting that that was the comparison instead of Wendy's as well, going hand in hand when you click on it through the McDonald's side. But if we go back here, so I'll scroll down, close up. To point out one thing, they both have the 3 stars. And we'll get into that in the next slide or two. And then if we scroll down here, okay. So as you can see, the numbers kind of go different where like you see some drastic changes within the 1 year returns. So you saw like a rise within McDonald's at 4.10 and then oops. And then over on the right with Wendy's, you see that they dropped by a negative 50.98. So that's a big not good sign right away. And then again, for revenue growth within the latest quarter, you see a slight but still a growth within McDonald's at 2.95%. But if you look over here, negative 3.04. So again, you see these dropping numbers, which are quite staggering and quite concerning. So kind of to break it down to a comparison here, McDonald's earns from stores worldwide and Wendy's relies on North America, so they're seeing not as much of that earnings and income coming in because they are so limited. Um, and then McDonald's franchise model cut costs and Wendy runs company-owned stores. So by having McDonald's so dispersed all over, those costs are being distributed, whereas Wendy's, it's all going back to strictly the company-owned section. So, and then we have McDonald's uses apps, so like their loyalty program, or they'll partnership with like delivery, other apps to, make that accessibility, and gain that customer income, and again, boost sales. And then they have constant cash flow that supports payouts. So with these different assessments and fair values, you can see that they are doing a lot better with their strategics and overall their, customer relations in comparison to Wendy's, as they're just dropping down. And a big, big thing for Wendy's is not being international. That's something that really hurts them, especially within their returns and revenue growth. So moving forward, um, kind of pinpointing here in the middle, you're kind of seeing these things arise already, but some themes to point out. So we have for, positive happenings for McDonald's, their global footprint. So again, they have stores in, 100 or more countries. They're diversified. They are getting revenue from all over. Pricing power. So this means they just have that room to steadily rise menu prices, to match whatever inflation is happening, with those causes that they can't control, but they can maneuver with it because they have that flexibility too, unlike Wendy's because they are smaller and not as all over. And then we have digital leadership, so consistent app, loyalty programs. Again, they're partnerships with deliveries and, easy click of a finger of ordering. Again, all attracting customers. And again, boost convenience equals boost sales. So people want it fast and they want it easy. And that's where they're stepping up above Wendy's. And then if we look, kind of scoring in on Wendy's here, opportunities, they are a smaller size, so they have that window to open for international expansion into, for example, Asia or Latin America. But the question is, will they take that step further and can they afford to take that step further? And then challenges they face, of course, highly sensitive to competition and cost changes. And again, those unmanageable happenings, they can't work around as much as McDonald's can because they can't necessarily change any sort of, global thing that's happening, but they can adapt and work around it, whereas Wendy's doesn't have that wiggle room. So we continue on. So performance, I'll show you how to pull it up on Morningstar. So we go under performance. And it's very scrunched here. I'm sorry. But here we have more of the full picture for McDonald's. Um, but the main thing to look at is as we scroll down and the fair values here. So if we're comparing these fair values, we can see that for McDonald's it was 317. And then for Wendy's it was 13.43, which is a big jump, but also they have very different close prices. So again, 299.66 versus 8.97. Um, they both rise above those, but it's just a matter of, who's doing better in the long run, which of course is McDonald's. So to kind of look at this big picture here, McDonald's has, more of an up fair value, because it reflects global dominance, pricing power, and reliable profits, whereas Wendy's, theirs is still up within their radar, but in the grand scheme of things, in comparison to McDonald's, it's lower. And this illustrates smaller size, limited markets, and higher business risk. So we continue on here, and if we scroll down, we'll get to the trailing returns part. So, again, for McDonald's, then Wendy's, both industry index. And then, as you can see here, I specifically, to make it a bit easier and to narrow in, went from the 1, 3, and 5 year. Um, so again, kind of like before looking at these, you see drastic changes. For example, with the 1 year, we see a 4.10 increase for McDonald's. We have that negative 50.98 for Wendy's. Um, Again, at that 3 year, they're reaching that negative point 1736. Though it's less than the 50, that's still detrimental. And then for year three, we see on the McDonald's side it grew, not a lot, but it grew. There's that growth continuing. So they both have the 3 stars, which just means fairly valued. But if we go into specific comparisons, we see that for the first year, Wendy's stock dropped drastically. And this could be because of weak sales and cost pressures, but McDonald's stayed up, again, because they have those concrete prices and they're racking in those digital sales. Then for uh, the second one, but year three, we have Wendy's facing slower expansion and no international reliance. But again, McDonald's kept that steady franchise income because they're pulling in from all over. And then for the third one, the 5 year, McDonald's long-term digital investments paying off. So their mobile app, their loyalty points. Um, while Wendy's falls behind in innovation and market reach because they're not taking that initiative to give, the evolution of what customers wants, which is, more of a click on the phone than having to go in and it taking a whole process. And so kind of to wrap all this up, kind of bring it back together. And this even kind of connects to the section that I was writing about because I did a lot of the comparison between these two and when looking to invest between regard to these two, it is better to go the McDonald's route. Um, so for the outlook wise, and again, this is all connected to back to McDonald's. Mostly positive, stable long term. They have those consistent earnings and that brand strength. Um, as for their moat rating, they were given wide, so they have those durable advantages. Um, again, looking from a global scale, pulling in from all over. Um, they have that brand power and supply chain efficiency, and their customer loyalty is highly there because they are listening to their feedback and giving them what they want. If we look at the Wendy's comparison mode, they got narrow. So again, they have that less international grasp. They have that low pricing power because they're not all over and they can't adapt as well to these unmanageable changes. And then a weaker digital presence because they aren't evolving to the modernizing technology of what people want today. Um, and then lastly, we have key drivers of fair value. So comparable sales growth through pricing, menu innovation, and high traffic, unit expansion across high growth international markets, and then digital engagement from again, those loyalty online programs, ordering, and then even those partnerships within deliveries. So overall, this comparison between Wendy's and McDonald's shows to go with McDonald's because they are listening to their customers, they have that brand strength, and they are continuing to grow around the world. So, yeah, thank you for listening.
An insight about the competitive ecosystem between McDonald's and Wendy's. Some features of McDonald's are they are an extremely large global presence with over 100 countries supporting their franchise. They also have consistent menu and fast service model, as well as having a value menu and superior mobile app deals, where Wendy's features are more along the lines of fresh, never frozen beef positioning, customizable burgers with premium toppings, and the Frosty, which is a staple in fast food. Some of the strengths of McDonald's are they have the strongest brand recognition in the fast food industry altogether. They also are highly efficient supply chain and have highly efficient supply chain and franchise models, which keeps costs low. Wendy's has a perceived higher food quality compared to a lot of other competitors, including McDonald's, Burger King, and all those. And they also have a strong social media presence and modern brand voice. They have an Instagram account, um, which garners many followers off of comments alone on random pages. Their weaknesses, however, is McDonald's often criticized for lower food quality and heavily processed ingredients. Their menu also changes uh, repetitively and it's less innovative. They're bringing back a lot of the same stuff they have already had. Whereas Wendy's weaknesses are a smaller market presence with fewer locations and less conveniences, and they have slightly higher prices, which can push away budget focused customers. The opportunity. Based off competitive analysis, there's a clear opportunity for Wendy's to differentiate itself by leaning more heavily into freshness, quality ingredients, and digital loyalty engagement. While McDonald's dominates in scale and speed, Wendy's can grow by positioning itself as a premium but still affordable choice in the fast food market. This means focusing on taste, freshness, made to order offerings, and expanding loyalty driven customer retention. Their quality and freshness as a point of differentiation is Wendy's already emphasizes a fresh, never frozen beef, which is something McDonald's cannot fully claim. Leaning leaning to the message and promoting taste and quality improvement, and which separates Wendy's being viewed as just another fast food option. The opportunity to capture the premium fast food gap is consumers want better tasting food, but still at fast food prices and convenience. Wendy's can position itself between basic fast food, McDonald's, and expensive fast casual like Five Guys, Shake Shack, giving customers a middle ground option that feels worth paying for. So they're fishing for from both markets. Their strength in loyalty and digital engagement is Wendy's mobile app and rewards programs are underutilized compared to McDonald's extremely strong digital presence. Growing digital deals, mobile ordering, and personalized offers can help Wendy's better retain customers and increase repeat visits, especially among younger consumers. The market analysis is fast food burgers remain highly competitive, driven by convenience, price sensitivity, and brand loyalty. McDonald's continues to dominate the market through scale and digital engagement, while Wendy's is positioned to grow by emphasizing quality, taste, and premium fast food offerings. Customer trends show increased interest in better fast food, meaning fresh ingredients, customization, and loyalty rewards, which aligns well with Wendy's brand strengths. Also, factors like rising food costs and increased use of mobile ordering influence how brands compete. Wendy is positioned to capitalize on consumers wanting better quality without losing any convenience. McDonald's holds roughly 31% of the U.S. food market, or fast food burger market specifically, and it has over 14,300 US locations, giving it major scale and brand visibility, as well as um, a lot of these restaurants are in uh, very high traffic places like Times Square and Hyde Park in Boston. And Wendy's only has 6,000 locations, which is smaller but allows for more brand consistency and the quality control that they strive for. McDonald's, however, has a superior monthly app user base with over 50 million monthly app users. Their digital and loyalty engagement is massive, which shows how important mobile rewards are for customer retention. The market analysis, uh, the key players are McDonald's, Wendy's, Burger King, Chick fil A, KFC, and Taco Bell. And McDonald's market value is approximately 331 billion, and its historic growth rate is around 4% annually. But with um, the mobile apps that engage in delivery, like DoorDash, Uber Eats, Grubhub, etc., with those going up, it is expected that their growth rate is going to reach approximately 5 to 6% annually. The cost of entry is very high due to brand loyalty, um, and a super cutthroat market with already established players. Their pricing strategy, um, the pricing strategy for McDonald's are their limited release items, which are items that can come in from different countries that they're showing here. And their mid-level price point is core menu focus, like Big Mac, McChicken, uh, all those. And the economically friendly price point is the dollar menu and the value menu at Wendy's. Customer or context. The fast food market remains highly competitive and brand driven. McDonald's currently leads due to its global scale, pricing power, and strong franchise model. Wendy's is positioned smaller but focuses on food quality and menu innovation. Growth in the market is being influenced by convenience trends, mobile ordering, delivery apps, and consumers looking for fast but better quality food. Competition is increasing from chicken focused brands and healthier alternatives. Segment one is value focused customers. They want low prices and fast service. Number two is convenience buyers with who mobile order, delivery, and they have busy lifestyles and need a convenient place to eat. Segment three is the quality first fast food customers, which lean more towards Wendy's due to the freshness and the never frozen beef marketing. And then segment four is families, which brands competing through kids meals and consistency. Where McDonald's has a Happy Meal with the toys, and they're overtaking in that realm. The market analysis is the market position. McDonald's is a clear global leader in fast food industry with a massive store footprint and strong brand recognition. Its scale allows it to keep prices competitive and maintain consistency. Wendy's, while much smaller, positions itself as a quality focused alternative with fresher ingredients and more premium menu items. The customer appeal is that McDonald's attracts customers who prioritize convenience, speed, and affordability. Its value menu and widespread locations make it easy to choose. Wendy appeals to more customers who care about taste and ingredient quality, especially with its fresh, never frozen beef messaging. Both brands share similar audiences but emphasize different strengths. And then pricing and trends is McDonald's uses a tiered pricing strategy to offer both low cost options and occasional premium items, helping it stay competitive during economic shifts. Wendy's prices tend to be slightly higher because it positions itself as more premium. As delivery and mobile order continue to grow, both companies are investing heavily in loyalty apps and digital deals to keep customers engaged.
All right. So hopefully this is working. All right, I'm going to be talking about the revenue models for Wendy's and McDonald's and why I think you should invest in McDonald's over Wendy's. So both of these, large fast food corporations, with McDonald's being larger. Um, and the way they make money, so they both have two different revenue models. They're sort of similar, but McDonald's, they have more of like a real estate driven model just because um, the franchises, the individuals that own the franchises, pay rent and royalties to McDonald's, while Wendy's makes their money because of their share of the restaurant and getting fees from the franchises and charging them. While they both make money from the individuals that have the franchises, they just do it in different ways. So on this with Wendy's, this photo of Wendy's, you can see how they're getting their revenue in the bottom left here. Um, so probably about 35-40% is all from the actual sales of the food, with Then you can, if you look over, franchise royalties makes up the next biggest portion. Um, and then advertising funds comes third, and then franchise rental income, and then fourth, franchise fees. So you can tell that they don't really make that much off of their fees. They just make their money primarily off of the actual sale of the foods. So key activity for both of them would be food supply. So McDonald's has one of the biggest and most advanced food supply systems in the world. Each company, they both get about 2 or 3 deliveries each week. With, potatoes, meat, lettuce. Um, so they have to constantly keep up with their deliveries. And to do that, you have to have a massive network. So the fast food industry just requires a lot more moving parts, I feel like, rather than a restaurant because, you're doing such a high volume compared to, a smaller size restaurant. Um, yeah, so these companies, they both partner with third-party logistics companies. Um, so I believe McDonald's uses Martin Brower and Wendy's uses Quality Supply Chain Co-op. And those companies, organize and plan all the deliveries. So scaling operations, there's actually a really good movie about how McDonald's started and how they scaled. They were the first company to kind of create fast food. Um, you paid, you got your food. You didn't have to wait for them to make it because they already had it made. Um, Forget the movie, but it's one of my favorite movies. Um, so they both began by franchising and letting individuals open up their own store, but taking their own cut. So this really helped them grow exponentially, just because they didn't have to do it all themselves. They had other people doing it for them, basically. Next thing that came with scaling their operation was their supply chain. So just how I talked about how many moving parts there are in the fast food industry. Supply chain was next, and they had to figure that out as they kept growing. Third thing was marketing and branding. Everyone knows McDonald's from their golden arches, Ronald McDonald, I'm loving it slogan. Now Wendy's, I think they've calmed down a little bit on it, but especially during COVID, they were tweeting out, kind of wild tweets and replying to people kind of in really funny ways. And that definitely helped them grow a lot. And the fourth thing to scale and to honestly just keep both their companies alive is introducing new products and using newer technology. I got McDonald's last night and I ordered it on the little kiosk they have in there. It took 45 minutes, so I don't think I'll be going back to McDonald's, but overall they are a massive company that's going to stay around and their revenue, which we're about to look at, is really going up. Um, so, starting with McDonald's, you can see in the top right, 2013, um, they're worth 28 billion. And then 2020, 19.2 billion. Um, that's where they're kind of peaked at their low or they were at their lowest, during COVID. No one was going out, no one was eating out. Money was tight for a lot of people, but now you can tell that their revenue is really going back up. And it's going to be a great stock to own as they are the biggest fast food company out there. And they're only going to improve unless, another pandemic happens or the economy just totally crashes. Now, Wendy's over here, they've kind of, you can tell, the quarters for each year, they're going up. It just, it's much slower than McDonald's. And there's more bumps in their trajectory overall, but McDonald's overall, much bigger and better stock to have. Thank you very much. Hope you enjoyed the project.